Just 1 second.
All right. So we start off with the last chapter under equities. Might take us slightly longer than the other chapters, might take us a couple of sessions. But this is one of the most practical chapters on equities, with potentially a few practical questions coming up as well on certain calculations that we might be required to do. So allow me just a second while I log in to share the pad. You want to see? All right. So far, just a quick revision. We have completed all the corporate chapters. We have almost done all the equities. We are on the last chapter when it comes to equities. And this is a foundational work on chapter number is 46. So we are chapter 46. The work that we're here supposed to do is understand how to value stocks in general. So valuation of equities, what are dividends, what are stock splits, dividends, dividends, stock splits, repurchases, all of these things is what will be dealt with in depth in this specific chapter, right? Uh, uh, to begin with. So what we'll be doing over here is we'll look at basic tools in order to value equities. It's like equity valuation tools. And the first thing that we'll be dealing with is going to be dividend split and repurchases. All right. So the chapter or what we're going to deal with right now, I mean, up until now, what we have done is we've looked at how to build research reports and what are the commonalities or different things that you should be aware of when you're looking at a research report. Front matters, buy sell recommendations, creating a detailed research note on the entire industry, trying to understand growth factors, growth parameters. So multiple things that we have dealt with so far are going to be helpful in this specific chapter so that we can finally get to a valuation of the equities as well. So up until now it was about how to prepare a report, how to analyze the industry, and it was more about how of different things. Now we're not going to be dealing just with how, but it in fact with what exactly is to be done in order to value. So how is kind of done, and now we're getting into the what of things. So with that, within equity valuation, just allow me a second. Let's try to understand the few basic concepts. Give me 1 second. Why? Stop. All right. So first thing first, when we are dealing with equities, we need to understand these three things. Equities give you dividends. Sometimes equities may have splits, sometimes they may have repurchases. But the fundamental logic of valuation, or the most foundational methodology of valuation, it basically tells you that value of any asset or value of anything for that matter is nothing but the present value of all the future cash flows. So if I ask you what is the value of a bond, uh, Give me a second. Yeah. So if I ask you what is the value of a bond that is expected to give you $110 a year from now. So at the end of first year, you will get $110. The next question, which you should ideally ask me, okay, that $110 is coming 1 year from now, which means the value 1 year later versus the value today is of course going to be different. You'll have to ask me, sir, what is the rate of return that I'm getting in markets? If I tell you that the rate is 8%, and if I ask you to value this bond, the value over here is going to be this 110 divided by 1.08, which is the 8% discounting factor which I'm using, which means the value in this situation is going to be $101.85 for this specific bond. So idea over here is pretty simple. Value of anything in general is the present value of all future cash flows. This was of course an oversimplification. Bonds in general will have a different characteristic. They will have a coupon and redemption. So let's assume a 2-year bond which pays you coupon of 10 plus 10. And let's assume that the redemption is 100. Now, if I ask you to value this asset class, again, the fundamental factor remains the same. So the value in this situation will be 10, which you get a year from now will be discounted at 8%. And the 10 which you get 2 years from now will be discounted at 8% to the power of 2, because you have to pull it back by 2 years. And the 100 which you again get 2 years from now will be discounted at the power of 2. So in simple, I don't have to write this twice. I can just say it is 10 divided by 1.08 and 110 divided by 1.08 whole square. Because if I just look at the cash flow patterns, I'm getting 10 here and I'm getting 10 plus 100 here. And the interest rate is 8% and the interest rate is 8%. So I have to pull this back one times, which is 10 by 1.08. And then I have to pull it back twice from here to here and then here to here, which is 110 divided by 1.08. And then the factor again divided by 1.08, which means nothing but the factor that I came to, which is 10 by 1.08 plus 110 divided by 1.08 whole square. So it's about what is the cash flow that you're getting at what point of time and how many times you have to pull it back in order to get to your present value. So let's just do a very simple calculation. The number for the first one will be 9.259. 110 divided by 1.08 to the power of 2 is going to be 94.307. Now, if I just add plus 9.259, it gives me a present value of 103.566, or 10, it is somewhat equal to 103.57. So this is the value of the bond today, which gives me 10 on the next year and 110 a year from now. Similar to that, if I have to talk about equities, the idea kind of remains similar, that the value of equities will be nothing but the cash flows which I get year in and out. So again, here you'll have to look at, okay, how many years are there? Is it 1 year, 2 year, or whether it is 3 year or 4 year or 10 year? You'll have to look at what is the cash flow that you're generating at any given point of time. And you'll have to discount all of them back to the present value in order to get to its valuation. So fundamental logic behind valuation of both equities as well as bond kind of remains the same, is what we have to be comfortable with to begin with. So we should have comfort in that when we are starting off with this chapter. Now, if I just go back to the discussion that we had in case of efficient market hypothesis. Efficient market hypothesis told me that the markets in general are efficient. So there were two things. One thing was an efficient market. Second thing was an inefficient market. An efficient market is where you have no arbitrage. The valuations are fair. And I mean, there are degrees to it. Inefficient is where there is arbitrage opportunities. All information is not reflected, and so on and so forth. So an inefficient market has these problems. Efficient market solve for these problems. Within efficient, we had weak form efficiency. We had semi-strong form efficiency, and we had strong form efficiency. Weak form efficiency basically told me that I cannot use historical data because my present share price incorporates all the historical data, which means that technical analysis is not going to work. Fundamental may work, but technical analysis is not going to work. Semi-strong form tells me that all the information is actually reflected in the stock prices immediately, which means even fundamental analysis is not going to work in this specific situation. And finally, we have super strong, or let's say strong form efficiency, which tells me that even insider information is reflected. So nothing is going to work in this specific situation. The only thing which you should do is do passive investing. Even in case of strong form, you should do passive investing only, because nothing is going to work. So ideally, the end idea over here was that in case of an efficient market, the equities in general are going to trade at their intrinsic value, or they're going to trade at their fundamental value. Now the question arises that okay, they'll trade at their intrinsic value, they'll trade at the fundamental value, you can call it fair value, or matlab, you can give any number of fancy words to it, but the idea continues to remain the same, that it is the price at which rational investors who are unbiased would be willing to do a transaction at an arm's length basis. That is the basic definition of this specific thesis, right? So rational investors who are biased in whatever way, and are unbiased and knowledgeable, are willing to do a transaction on an arm's length basis. So it's like uh, whatever that price is basically the fair value. That is the fundamental definition of a fair value. What it is basically trying to tell me here is that the transaction will not be shady. It will be executed by market participants, and it will be executed by people who are knowledgeable and kind of unrelated. It's not necessary that they are unrelated, but the value at which the transaction happen is on an arm's length basis, which means the transaction is between two parties who would have transacted in the same way had they been unrelated. Because if there is a relation between mother and father, let's just say, or let's just say a son and a father, that the transaction may happen at less than arm's length or something like that. But in case of unrelated parties, which is let's just say me and Mr. X, whom I don't know, if we end up doing a certain transaction, it is likely that the transaction is going to happen at arm's length. So again, these are just, I would say, high level things, very fundamental or groundwork related things. This is things that you should know, that okay, from a definition point of view. So this is what the definition of fair value, or this is what the definition of intrinsic value or fundamental value is. Idea here is that whenever you're creating, whenever you're working as an analyst, and whenever you're trying to create, or whenever you're trying to get to the intrinsic value, you should try to use this valuation methodology in order to come up with the fundamental intrinsic value, which means you have to use a valuation model which gives you fair value, or which gives you intrinsic value, or which gives you fundamental value of the stock. So that is what the basic idea is when you are analyzing any stock and trying to, or analyzing any company and trying to come up with a valuation to that, right? uh so that's like the most basic fundamental thing that you have to be careful about as an analyst. Next things going forward, maybe we can look at a question to begin with, or we can before we move into question, let's try to understand. Ye to I have just given, okay, you do a fair value. The question is, how will you get to this? Because I have just said that this is the value at which knowledgeable parties are willing to do a transaction, but that does not tell you that okay, at this number the transaction can happen and it can be called a fair value. So while fair value is a good definition, the problem is it is not a good methodology. Fair value is a good definition. It tells you it should be arm's length and knowledgeable parties and all of this thing. But how do I get to that number? This definition does not tell me that a script should be traded at $100 or whether it should be traded at $50. Which one is fair value? The fair value definition does not tell me that. So there are multiple ways in which you can get to those valuation methodologies. The first and foremost, which is usually the most recognized methodology, is called discounted cash flows, famously known as DCF method. In case of discounted cash flow model, again there are bifurcations, but what you end up doing in case of a DCF is you build a model, try to understand what sort of cash flows are generated using that model, try to look at those cash flows, discount those cash flows back to the present value and get to your number similar to what we did over here in case of our example of a bond. So when you're doing this sort of calculation, where you're looking at the cash flows, discounting it back to the present value, that is where a DCF basically ends up happening. However, a DCF is not that simple. A DCF can be done in two different methodologies in this situation. There are more, but two basic fundamental ways in which you can do. One is called a dividend discount model. And please note this down. First one is called a dividend discount model. The second one is basically called a free cash flow for equity model, also known as FCFE for short, and DDM for short. But nobody calls it DDM. You usually say dividend discount model. Here, in case of free cash flow for equity, a lot of people, they would usually just say, okay, this is free cash flow for equity, and directly kind of use that. So this is, let's just say, part one of your analysis, which is DCF. Part two is somewhat, I mean, in general, we call it relative valuation method. In our books, it is also called multiplier method. Within multiplier method, what you end up doing is, and the name relative valuation might give you a little more idea. So what you do is you look at similar companies. For similar companies, you try to see what is the value that they are trading at, and you adjust for the scale and multiply in order to come to your number. So certain ratios, key ratios that we use, for example, price to earnings ratio, or for example, price to book ratio, or for example, EV to EBITDA ratios, and we'll look at these ratios in just a bit. So you look at what is the price to earnings ratio of the competitors, and then you try to come up with valuation for your own company. So for example, if I ask you, how will you use the relative valuation method in order to value, let's just say, Unilever? So you'll say, okay, Unilever is a listed FMCG company. You'll try to come up with more FMCG companies, so as to say, which can include the likes of Nestle. It can include some other company. I'm not sure whether these are listed, but there can be some other companies here and there. There are companies like Parle in India. There's Britannia, and you have Procter and Gamble, which can be considered as a listed company in FMCG space. Gillette can be another, although it's slightly different, but let's just say it's still an FMCG company at the end of the day. So you look at what are these companies trading at. So it'll be like, okay, Nestle price to earnings is, let's just say, 22x. Let's just say Parle is at 23. Let's just say Britannia is at 24. Let's say PNG is at 30. And let's just say Gillette is at 25. So here you will try to come across the mean slash average or the median multiple for these companies. So in this situation, let's just take a simple average. We don't have to complicate it beyond what is required. So I have 22 plus 23 plus 24 plus 30 plus 27 divided by 5. So I get to a 25.2 as multiple. So this is basically the price to earnings ratio, which is applicable in our situation to Unilever. So if I want to know the price, so basically I want to know the value, value in this case can be price. I know the price to earnings ratio. I know the earnings which is available. Earnings, let's just say for Nestle is, let's just say $2 per share. I know the price to earnings, which is 25.2. So I can come to the value, which is price, which is nothing but 2 into 25.2, which will be $50.4 per share. So are you able to follow? Basically, I'm saying that the price to earnings ratio, which is nothing but the price divided by earnings, which is in this situation 50.4 divided by 2, which is equal to 25.2. This is the usual calculation I do. That if I ask you to calculate the price to earnings ratio, you will say, okay, sir, tell me the price, tell me the earnings. You will divide price by earnings, and you will tell me 25.2 is a multiple. So instead of doing price to earnings multiple and coming and saying that this is trading at 25.2x multiple, you do the backward calculation where you say that my peers are trading at a valuation of 25.2 on an average. Hence, on an average, I should also trade at 25.2. Sir, can you tell me the earnings? I'll say $2 per share. And you say that, sir, if the earnings per share is $2 and the multiple is 25.2, the value per share in this situation should be $50.4 a piece. So that is again a methodology that you can use, also known as relative valuation method or multiplier methodology. So you look at price to earnings, you can look at price to book, you can look at EV to EBITDA methodologies in order to calculate your overall number. This will come tomorrow, but these are just certain things that are kind of good to remember. That will help us later on. So we have done DCF, we have done this. The third is usually the most fundamental method that you can think of. However, in today's world, nobody values it, companies this way. This is an asset-based model. So what it basically tells you is that don't look at price, earnings, don't look at DCF and all of that. Just to do a simple methodology of valuation. If you ask me what's my value, I'll say that, you know what, my value is I have assets worth $1 million, which is, let's just say, this house, and I have total obligations of 100K to be paid over the next 1 year, which I have already, let's just say, accounted for, which I'm already obliged to pay. So my valuation is 900K. This is the most simple methodology which you use to value most of the asset classes, including the net worth of individuals. A net worth is nothing but your total assets minus the total liabilities. So TA minus TL, which is equal to net worth, is what we use to value most of the individuals, right? So why is Elon Musk worth $300 billion and so on and so forth? You look at their total assets and subtract whatever minuscule liabilities that may have, and you get to their net worth. Similar to that, you can use asset-based model even for companies. There also what you will do, you will just look at total assets that the company holds, reduce all the total liabilities that the company has. And once you reduce total liabilities from your total assets, what's left or what is remaining is nothing but your net worth in this specific situation. So asset-based valuation tells you what is the excess assets that you're holding on to, and it tells you the overall valuation that you're supposed to get based on the asset holdings that you have, right? So this is the three valuation methodologies that you should kind of just be on top of for the time being. So you have DCF, you have relative valuation, and you have asset-based valuation models. So let's just remember these three things. Of course, we'll go in detail into each one of those as we move forward. But these are like the foundational work that should be remembered in order to ensure that you can do equity valuation or asset valuation in a better way. Now let's try to understand. Let's try to go deeper into one of these, which is, let's just say, your DCF or discounted cash flow. I'm going to use them interchangeably for now. And let's try to look at the nuts and bolts, or let's try to do some groundwork over here. So in case of DCF, what I need is the cash flows, which is thing number one, and the discount rate, which is thing number two. If I know the cash flows and if I know the discount rate, I can get to valuation of anything just like how I did over here when we began. I gave you cash flows, I gave you the discount rate, and you came up with the value of $103.57 per share per bond in that situation. So now when I'm doing DCF, two things that I need to know is cash flows and the discount rate. So now let's get started with the initial framework that we're talking about, which is about analyzing or getting a understanding of what those cash flows are. So first and foremost, within your cash flows, in case of equities, For you as an investor, the most simple thing that you end up getting as cash flows are called dividends. What are dividends? Dividends are nothing but distribution of companies' profits. So whatever profits the company is earning, when you're distributing those profits to the individuals by way of dividends, that is nothing but the distribution of company's profit is nothing but dividend. So let's just say if I'm holding on to a share worth $100, the company will declare a certain dividend. Let's just say they declare a dividend of 3 per share. So every share that I hold, I'll get $3. So for example, let's just say I own 1500 shares, which means my total investment is 150000. If a dividend of 3 per share is declared, I'll get this into 1500, which is 4500 as dividend, which will hit my bank account. A very simple way to look at it. Within dividends, you need to be slightly within dividends, you need to be slightly more careful. There are multiple ways or multiple types of dividends which can be paid. One is a regular dividend. Regular dividend is a dividend that company pays every year, or it can be every quarter, or at a certain frequency. So these are dividends that companies pay in general based on their cash flows. Some companies pay dividends every quarter, some companies pay dividend every year, some companies pay dividend every 6 months, some companies do not pay dividend at all. So regular dividend is what they generally pay. It's usually expressed as a percentage of profits. Usually companies have a policy that out of my profits, I will pay 30% as dividend, or out of my profits, I'm going to pay 70% as dividend. So that policy is something that is to be known and understood, and accordingly dividends get paid out, right? Uh, on top of regular dividends, you have something called special dividends. What do special dividends do? They are paid, they are one-time dividends, uh, paid for something special. This is as the name prescribes, it is not regular dividend. This is one time. This is paid for special events, and these are one-offs in nature. So it may so happen that, let's just say, Unilever, which owns multiple businesses, they have beauty, they have fashion, they have, let's just say, ice cream. Let's just say they sell the entire ice cream business for $100 billion. And this $100 billion, of course, now is with Unilever. They have nothing to do with it. They distribute it as dividend to the investors. Now, this is a special dividend because you don't anticipate that every year Unilever will sell one of the business and give cash back to the investors, right? Because this is outside the normal course of their business and can be anticipated to be a one-off. For that reason, you call it as a special dividend. So special dividend are used in certain favorable circumstances, some certain scenarios, in order to make a one-time payment to the shareholders. And this is not something that is received every year, is what you have to understand, as the name prescribes. So regular dividend is received every year, every quarter, every month, as the case may be. Special dividends are one-off, which are not received at a a regular frequency or regular interval. There are a couple more types of dividend which is there. One is called stock dividend. You should think of it as, let's just call it, I mean, I don't want to name it a scam, but it's most likely like a scam. So what stock dividend does is, it basically tells you that every owner of a share will get one share for free. And this is something that happens every now and then. Sometimes stock dividend is also called bonus issue. So stock dividend and bonus issue are one and the same. What they end up doing is, every owner of a specified number of shares will end up getting a specified other number of shares as well. And this can be done in many ways. It can be 1:1, which means one owner gets one. It can be 1:2, which means someone who owns 2 shares will get one more share. So owner of 2 will now become an owner of 3. 1:4 basically means someone who owned 4 shares will now get one more share and will now become an owner of 5 shares. So this is how stock dividend is calculated. It can be expressed as a percentage as well. So if I say that 25% stock dividend is given, it basically means that if you owned 100 shares, you will get 25 more shares and your holdings will become 125. It is similar to saying 1:4. An owner of every 4 shares will get 1 more shares and his ownership will become 5. So 100 is nothing but 4, 25 is nothing but 1, 125 is nothing but 5. So similar to this, stock dividends are declared. One thing that you have to be careful about is nothing in life comes for free. If you could just artificially create value like this, every company should just declare 1:1 dividend. Or why just declare 1:1? Declare 10,000 is to 1 uh, dividend. So owner of one share will now own another 10,000 shares, and value will now become sorry, the total ownership will now become 10,001 shares. But this is never value accretive, which basically means in real life what happens, let's just say there is a stock trading at 100. Let's just say Unilever shares are trading at 100. If you declare 1:1 dividend, which means owner of one share instead of one, his demat account is going to reflect 2 shares now. Immediately after the declaration, the share price will invariably become $50 a piece. Similar to that, if let's just say instead of 1:1, you give 4:1, which means owner of one share now becomes an owner of 5 shares, the prices will directly collapse from 100 and it will become 20. So the value kind of remains the same. Earlier, there was an owner of a share of, you owned one share of $100, so your value was $100. Now you will own 5 share of $20, which means your value remains the same. So in case of stock dividend, be very careful that there is no incremental value which can be created. You can't make money out of thin air unless you're the central bank. So you can't just make more shares and create value. The moment you give stock dividends, the prices collapse in accordance to that is the fundamental theory. Of course, it can change somewhat higher, somewhat lower. Instead of 20, it may become 19.9 or it can become 20.2. That is just market movement depending upon demand and supply. But it will definitely not become 70 or it will not become 2. So it will change in line with the stock dividend which is provided to the individual. So just be very careful when stock dividends come. A stock dividend does not create an artificial value. Giving shares for free cannot create artificial value. One more thing, instead of stock dividend, sometimes you call it stock split, or there is something called reverse stock split. So if you remember the discussion that we had, and be careful, stock split is different from stock bonus just in one fundamental way. Stock bonus, what happens is you get shares for free. Fundamentally, nothing changes. In case of stock split, what happens is, let's just say there is one stock of, let's just say, face value of $10, right? There's one stock having a face value of $10. Instead of having one stock of face value of $10, you can divide it into 10 stocks of face value $1. So you will have 10 stocks coming out of it with face value $1 each. So again, fundamentally, it's the same. Your one share is now divided into 10 different shares. So you have 1, 1, 1, 1, 1, and so on and so forth, 10 different shares. So in this situation, what happens is an owner of one share of face value $10 now becomes an owner of 10 share of face value of $1 each. So this is like the fundamental difference between stock split and bonus share. Bonus share, you still own the same face value, but you get stocks for free. However, in this case, the face value is split. It can also be split. It can also be so that one share of face value 10 can be divided into 2 shares of face value 5 each. Both are acceptable ways. It can also be divided into 4 of 2.5 each. I mean, you can divide it in whatever number you demand or you desire. So this division is possible. But fundamentally, a stock split, what it does is exactly the same as what bonus issue or bonus shares do. So fundamentally, they are the same. There is, however, one difference in case of stock split where you can do a reverse stock split. What is a reverse stock split? So instead of having the situation where you're converting one share of $10 into 10 share of $1, you do the exact opposite, wherein you convert 10 shares of $1 into one share of $10. Or you can also convert this into two shares of $5 each. So this is where you're reducing the number of shares. This is where you're increasing the number of shares. So this is like the fundamental difference. A reverse stock split is exactly the opposite of stock split. Instead of converting or instead of splitting one shares into 10 pieces, you assemble 10 pieces and you reconvert it into one piece. Why are they done? Mostly in most of the situation, they are done for some special purpose. It can be for some special purpose. That is thing number one. And more often than not, it is done in order to ensure that for bookkeeping purposes or in order to make it attractive. A classic example, let's just see what example that we can give over here. Give me 1 second. Let me just share my screen. Let's take the example that we had already taken, Berkshire Hathaway share price. Now, if you look at this, the problem with a Berkshire Hathaway share is basically that it is valued at 718,750 a piece, which means if you want to buy a single share of Berkshire Hathaway, you need to have at least $700,000 in your bank account. Otherwise, you're not going to be able to buy this. Just give me a second. Yeah. So unless you have 718,750 in your account, you're not going to be able to buy Berkshire Hathaway. I don't think there are a lot of people who have $1 million to spare on a single stock or a single equity, which means it is not everyone's cup of tea. Now, in order to make it more accessible slash attractive slash bookkeeping purposes, what you can do is, in this case, you have one share of, let's just say, face value 10. I don't know what the face value is. Let's look at face value if it is given. Face value. They've not given face value. Ideally, they should. So you don't have face value over here, sadly. Usually, in case of stocks, it's ideal to give the face value. Not sure about the bookkeeping that's done over here. Let's look at any other stock for that matter. Let's just look at maybe MRF. This is an Indian company. It's trading at 109,000 rupees, which is, I mean, INR is definitely not a strong currency, but still 109,000 rupees is by no means cheap, which means it's fairly expensive, so as to say. Let me just pin it over here. Now, what you can fundamentally do with this kind of stocks is, if I just go to, let's just say, BSC, I go to screener. I hope I have face value here. Yeah. So if you see, there's a face value of 10. So what I can do over here is, in case of MRF, you have face value of rupees 10. The market value, let me make it a little more simple. It's 109,260. Let me just say 110000. So it's 110,000 rupees. In order to make it more accessible, what I'll do is I'll divide this face value of 10 into 10 shares of face value 1. The moment I do this, owner of one share will now become owner of 10 shares. And the stock price, instead of becoming 110,000, will become 11,000, which is far more accessible. As a result of this, what will happen? Me, who otherwise could not have purchased even a single share of this company, I can now buy this company because I have 11,000 rupees, but I didn't have 110K. The same thing applies to Berkshire Hathaway as well. The value is some 800K. In order to make it more accessible, you can just do a stock split, divide it into, here you might have to do a further division. You instead of having one share, divide it into 100 shares. So you have 1, 2, dot, 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 followed by 100. And each share will now be worth $8,000 each. By no means cheap, but still much better than having to pay nearly $1 million to buy one share. So here stock split can help you with these kind of things. So we started off with dividend, but we have covered more than dividend. We know what dividend is. We know what normal dividend, regular dividend is. We know what special dividends are. We know what stock split is. We know what reverse stock split is. And we know what, just a second. We know what stock dividends are or bonus shares are. So those are things that you should ideally remember. Now within this, the next thing to be remembered is uh, share buyback, or so you have something called share buyback, also known as stock repurchase program. This is something that Berkshire did very recently. Very recently is actually 2023. Since then, Mr. Buffett has not been actively buying back his shares. What stock buyback basically does is you use your money in order to buy back your own shares. So what Berkshire will do is, let's just say there are investors and you have Berkshire over here. Berkshire will pay money to investors who sell their shares, and as a result of that, you're buying back your own shares. Usually what companies do is they issue shares. So usually most of the companies like MRF, let's just say MRF wants to start a new plant or factory. For this, MRF needs rupees, I don't know, 100 million, for example. How will they finance this? They will issue shares to investors. Investors get those shares, and investors will pay money to MRF, and then so your money flows this way. This is a regular transaction wherein company issues stock. The exact opposite happens when, instead of going through this route, let's just now assume that MRF actually is sitting on $100 million or 100 million rupees, and they have nothing to do with it. So if you are sitting on $100 million and you have nothing to do with it, of course, it's not a good situation to be at. When you're sitting on money of investors and you have nothing to do, a pathetic situation to be at. So what you can do is, sorry, the other way around. So you will have the investors will sell the shares and MRF will give them money. This is called a stock buyback. Why do I call it buyback? Because you're buying it back from the investors who you had earlier issued those shares to. So stock buyback program is basically accumulating your own shares, giving money out in order to reduce, let's just say, the overall number of shares in the company. What it also does is it reduces the cash of the company, and it makes the return ratios look a little more attractive because your overall equity goes down, the net worth goes down. So the company basically shrinks as a result of stock buyback programs. So this is again one thing that you should be prepared to understand. The final thing that we should understand again from this is to understand how dividend payout work. How dividends are paid. It's a 4-step process. Usually it is a 3-step. It can be a 3-step process or a 4-step process. How the process looks like is, you'll have a certain timeline. On a specific date, let's just say 22nd of February, what the board can do is, board declares the dividend. So board will say that I have declared a dividend of, say, suppose $5 per share. And this is usually by way of a market announcement. So the board of directors of a company on a specific day will say that 22nd of February, I declare a specific dividend to the individuals, right? Now the question arises, who are the people who will get this dividend? The answer is pretty simple. The people who are owners of this company, the people who are shareholders. But the problem is, when should he or she be a shareholder? Should he be a shareholder on 22nd Feb, or should he be a shareholder on 20th Feb, or should he be a shareholder on 28th of February? We don't know that specific date. Or do I pay this dividend to someone who was owner 1 year back? Right? Doesn't make sense, right? So you're actually supposed to pay dividends to current shareholders. That's why what you end up doing in this kind of situation is you end up putting a X dividend date. So on 22nd February, when you're declaring the dividend, you also do something called X dividend date declaration. So dividend, you will also declare an ex dividend date. What it basically means is that this is the date from which any owner of the securities will not get dividend. So only if you are an owner on X dividend date, you will be entitled to get dividend. So this is like the entitlement date. If you're an owner on this specific date, you will get dividend. If you're not an owner of this specific date, you will not get dividend. Usually, ex dividend date is kept after the declaration. In this situation, it can be, let's just say, 7th March. So which means if you are an owner on 7th March, you will get dividend. If you're not an owner on 7th March, you're not going to get the dividend. Next thing which you do is, usually depending on the settlement cycle, you will add +2 over here. This is again only for bookkeeping purposes. So on 9th March, which is, let's just say, the day from 2 dates from over here, you have something called a record date. What is record date? Record date is the date on which you look at the registers in order to declare dividend. So this is the date you look at the register. Now, this is why do I have separate record date and why do I have separate ex dividend date? I'll just explain in some time. And finally, towards the end, the last date is where you actually make the payment. Let's just say this is 25th March. I mean, it can be any date, but this is the payment date in my example. So first day you declare dividend. Alongside dividend, you say which is the date, which is like the cutoff date or ex dividend date. If you're owner on that specific date, you will get those dividend. If you're not an owner of that specific share on that date, you will not get a dividend. Then you have something called record date, which I'll explain in just a bit. Why do you have something called record date or holder of record date? And finally you have payment date. So I think this should be pretty easy. These are the 2 points which end up creating a friction. So ex dividend date helps you identify which date is it where you need to be an owner. But the problem is, if I buy a stock today, let's just say, I mean, of course I can't buy a stock today, it's the market is closed. If I buy on Monday, the problem with usual transactions, and India today is at a T+1 settlement. Earlier there was T+2 settlement, and before that there was greater settlement time lag. What happens is my money gets deducted today. So money moves out of my bank account today itself. In my demat account, it may reflect that, okay, I have gotten the shares, but reality back of the picture, it hasn't really happened. So what happens is, if your Monday is when you're buying, of course, there must be someone else also who has sold on Monday. So you are a buyer, someone else is a seller. So Monday is just the day wherein you have recorded the transaction. Another 2 days it takes for the registrar and the custodian to record this. So what the custodian does is, from here he will remove the shares, and then here he will include the shares. The same process needs to be run, and at the back end there are multiple things which are happening. It's not as simple a process as it looks like in case of our mobile devices, right? So when you buy and sell on Monday, actually, depending on which jurisdiction you are at, it may take Tuesday, it may take Wednesday, or it may take Thursday for the entire process to get completed. And after this has happened, only after this, the registrar will record that, okay, as on Wednesday, Mr. X, who was, let's just say, the buyer, and let's just say Y is the seller, is an owner. So the problem is, for different categories, the different dates exist wherein a person may be treated as an owner or a person may be treated as not an owner. So in this situation, while someone may be a buyer on a specific date, he will only be recorded after a certain date. So what usually ends up happening in these sort of transactions is, you will have an ex dividend date. If someone sells on this date, the problem is, registrar still feels that he's an owner, because in registrar the entry will only be done 2 days later. So you have a certain date kept as ex dividend date. You add 2 days or 3 days or 1 day to that, and after that you have a record date, and on this date you take the record, because the assumption is that 2 days have passed and the registrar has also recorded the transaction, which means today on 9th March, if I pick up the list of investors, it will reflect all the investors who have purchased on or before 7th March, and it will exclude all the investors who have sold by 7 March or who have purchased after this. So you keep a separate ex dividend date and you keep a separate record date. Record date is the date by which every transaction till 7th March has been executed, which means someone who sold on 7th, if someone sold on 7th, by 9th it will not be reflected, as a result of which he will not get dividend. Similarly, if someone bought on 7th, by 9th it will be reflected in his account, which means he will get dividend. So you have two separate dates in order to identify the entitlement. So first you declare. Along with declaration, you also have something called ex dividend date. You need to be an owner on ex dividend date in order to get dividend. Usually 2 days after ex dividend date is the record date. By this date, every transaction till here has been settled. And after this, towards the end, you make the payment, which can be 10 days from here, which can be 5 days from here, it can be 20 days from here, depending upon the locals' rules and regulations, and everything kind of combined. So that's how you basically end up coming with a price for the, that's how the mechanism at the back end basically ends up working for these sort of transactions, right? So with that, we have kind of done the initial bit, the initial framework of it. Let's look at a couple of questions from over here, and right after that, we'll go to the dividend discount model. Let me show you a couple of questions. Let me just open up the book. Give me a minute. All right. So let's look at these questions. All right. So based on what's presented in on the screen, can you let me know the answer to these 4 questions? I think 3 is presented. If you just let me know on the chat box, just type in 1 ABC, 2 ABC, 3 ABC, whatever you think the right answers are, and then we can quickly discuss and move forwards. Yeah. All right. So let's look at the questions. Let me tell you what the answer should be. Question number 1, it says, an analyst estimates a value of 45 for the stock with a market price of 50. So I believe that the value is 45. The market price, however, is 50. So I think it is trading at 50, but its value should be 45. So I think that the stock is overvalued. All right. The analyst will most likely conclude that the stock is overvalued if, number one, few analysts follow the stock and the analyst has less confidence in his model. If I'm not even confident on my model input, how can I conclude that the stock is overvalued? So I need to have confidence in the model in order to ensure that I can conclude. Next, few analysts follow the stock and analyst is confident. So if I'm confident on my model, which gave me a value of 45, and the market price is 50, and there are few analysts following the stock, in this case I'm going to be confident. So this definitely feels right. Next one is many analysts follow the stock and analyst is confident in his model inputs. Now the problem is, if many analysts are following the stock, it will be a fairly discovered stock. If it is a fairly discovered stock, and let's just say there are thousands of analysts who are actively tracking it, the problem is that the real prices, which according to me is right, may not necessarily be true, right? So in first situation, it's a trick question. If many analysts are following the stock, the chances of stock being overvalued is lesser, as a result of which, so 46.1, I think this is one of the best questions. A is definitely wrong. If I'm not even confident on my model input, I can't say that the value it is undervalued. B is right because few analysts follow the stock, so it may so happen that the stock is undervalued, and I'm confident on my model inputs, which gives me more and more confidence. And C is again a trick part, because if many analysts are following it, in that situation, the probability that the stock is undervalued goes for a toss. So B is the right answer in this situation. Second one, it says a valuation model based on free cash flows is most likely to be in. It's a very simple. It's a DCF based multiplier. What it does, multiplier will look at price to earnings, EV, EBITDA. Asset based, it basically does debt minus assets minus liability, and you have present value, which is the right answer in this situation, because in case of free cash flow for equity, we look at the present values itself. So for the second one, the right answer is going to be C. Let's look at the third one. A company is evaluating the likely effect of on its share price of declaring a 50% stock dividend or 3:2 stock split. Other things equal, which of these will result in a lower share price? So let's take these kind of situations, best thing to do is to make an assumption, and that will make your lives easier. And it is 3:4:2. So let's try to maybe assume that we have 100 shares to begin with, right? We have 100 shares of $1 each, right? Let's or instead of taking 100 of $1, give me 1 second. Let's take a better price. Give me a second here. Yeah. So let's try to solve it numerically. Let's assume there are number of shares is 100. Let's assume the price is let's say 20. Let's say it is, we can take whatever. Let's just say it's 10. I wanted to take a slightly different number because that will help us. Let's take 15, because 10, 100, it can get consuming, it can get confusing. So let's see what the effect is going to be. First one says 50% stock dividend. A 50% stock dividend basically means anyone who holds 100 shares will now get incremental 50 shares and will now become a shareholder of 150 shares. I know for a fact that it cannot change the value. So the value here was how much? 1500. I have to keep the value intact, which means earlier I had 100 shares of 15 each, valued at 1500 in total. Now I have 150 shares of I don't know how much each, but the valuation has to be 1500, because like we know, you can't artificially create value by doing a stock split or something like that, or a bonus share, or even a stock stock dividend, stock split, bonus share. They can't create value. So again, the value is 1500, which means the share price is 10. So now I know that if I do a 50% stock dividend, the price will go down from 15 to 10. Now let's see. So this is the first thing. Let's call it A. Let's look at what happens in case of B. B says 3-for-2 stock split, which basically means if you were owner of 2 shares, you will now become owner of 3 shares. So if I own 2 shares, I become an owner of 3 shares. So which means if in my example, if I own 100 shares, I'll become an owner of 150 shares in this situation. 2 becomes 3, 100 becomes 150. If you look at it, it is exactly the same example as over here. So earlier you had 100 shares of 15 each, which was valued at 1500. Now you have 150 shares. Again, the value is what you have to find out. The value will continue to remain 15, but the value per share will now have to go to 10. So basically, the value here is going to be 10 in the first situation where you have a stock dividend. The value in case of second situation where you have a stock split will again be 10. So the value kind of remains the same in both situations. So the answer over here will be both should have the same effect, because you are essentially dividing 2 shares into 3 shares, both in case of the first example and in case of second example, which even if you just do a plain reading, 50% stock dividend means 2 shares becomes 3 shares, and 3-for-2 stock split means 3-for-2. Yes. 2 shares become 3 shares over there. So whenever you're making 2 shares whenever you're converting 2 to 3, whether you're doing a stock dividend or a stock split, the ultimate impact is going to be the same. So your answer over here is both should have the same impact. Finally, we have the first day on which the purchaser of a stock will not receive dividend that has been declared is going to be your ex dividend date, because we know for a fact that if I go back to my timeline, where is the timeline? Yeah. So here, if I just look at my timeline, it's slightly clumsy, but this is the day that declaration happened. If I am a owner on X dividend date, then I get shares. If I'm not a owner on X dividend shares, I'll not get shares, because only an owner of X dividend date will be recorded on the record date, because it takes 2 days in order to facilitate the transaction, right? So anyone who is not an owner on X dividend date will not get dividends. Anyone who is an owner on X dividend date will get dividends. So the question here is, let's read it out again carefully. It says, first date on which purchaser of stock will not receive dividend that has been declared is the X dividend date, because only after X dividend date, if you are a if you end up executing a transaction after ex dividend date, you are not going to get any dividends. So the answer here is going to be B. And just note down this chart as well, I think. Yes. So here you have this chart similar to the chart that's created here. So you have declaration date followed by ex dividend date plus 2 date, which gives you holder of record date, and then the payment can be made 2 days, 5 days, 10 days, 20 days after, as the case may be. So in this situation, ex dividend date is the date when you don't end up getting. So this is the first day on which share purchaser will not get uh the next dividends. So the first date on which you don't get the next dividend is basically the ex dividend date, because only if you are an owner on or before ex dividend date, you end up getting dividend. The name itself is ex dividend, which means on this day it will not have dividend, right? X anything is basically not having that thing. So X dividend date is the date from which you become X dividend. You don't end up getting those dividends. So you need to be an owner before the X dividend date. If you're not an owner as on X dividend date, you will not get those dividends. The best way to remember is this definition. This is the first day on which the purchaser will forego the next dividend uh, which has been declared. So that is what should be remembered, and that tells you that first, second, third, and fourth, these are like the uh, uh, good few questions for us to remember, right? It basically sums up what we were trying to understand till now. So let me just unpin this. Let's get back to our original pad and let's try to go through the next couple of things over here. So now it will become a little more intensive in terms of calculations. We'll look at different sort of models. The first one, which we had declared, was dividend discount model. A dividend discount model can be for multiple periods. Let's look at the most simple example, which is 1 year DDM, which is 1 year dividend discount model. In this situation, what you do is the value today is going to be equal to the dividend on year one divided by 1 plus the required rate of return. So that is what you will divide it by, plus the value of share divided by 1 plus the required rate of return, which is nothing but the value today is equal to dividend that you will get at the end of the year plus value that you will get at the end of the year. Let's keep it value 0 divided by 1 plus the required rate of return. Please note this down. This is an important formula. So value 0 is equal to dividend 1 plus value 1 divided by 1 plus the required rate of return. So let's take a simple example. Let's assume that dividend next year is equal to $5. Value next year is equal to, let's just say, $75. Required rate of return, it can be RE, it can also be KE, which is cost of equity. Both are interchangeable in this situation. Let's assume that is 12%. Find out value today using 1 year dividend discount model. Yeah. So can you try and solve this question? I think it's a fairly simple, straightforward one.
Is it 71.4?
Let's see. So it will be equal to dividend one, which is 5 plus 75 divided by 1.12 or 1.0.12. So it is 80. Oh, just give me a second. 80 divided by 1.12, which is 71.43 or 71.42. So the value is 71.43 per share. In these kind of questions, they can create one trick. Instead of telling dividend next year, they will tell you that dividend this year is equal to $4 and it is expected to increase by, let's say, 25%. So this is one of the tricks that they have up the sleeve. Be very careful. You have to take dividend for the next year. You have to take the price for the next year divided by the rate of return, and that will give you value as of today. So which means be careful about these two things which I have written as one. You have to look at dividend and price as of next year. So be very vigilant and careful about these two things, right? So I think questions on the book might include that. So might be worth our time to look at a question that has this thing. So okay, you have dividend discount model, 1 year holding. All right, let's try to see this question. Can you try and solve this specific question? Is it still displayed on the screen? I think it should be. Let me just pin it down. Yeah. And note down that formula as well. Your value is equal to next year dividend plus next year share price divided by 1 plus K. So this is a good question. If you can quickly solve this, I think we'll be done with this first concept. And then we can move on to the next one. From now onwards, the chapter is only going to be about, this calculations and everything. Value of a stock that is one, and the numbers are slightly more trickier than what you get in general. Is it done?
Is it 12.81?
I think it's pretty easy to calculate. Let's see. So the dividend was 1 last year, and next year will be 5% higher. So it will become 1 into 1.05, which is 1.05, which is the next year's dividend. Plus, they've said that the stock will sell for 13.45. So next year's share price is 13.45. And then they say that the uh, one sec. And then you have the required rate of return at 13.2%. So you will do 1 plus, or let's just do 1.32. So it means your numerator is a total of 1.05 plus 13.45, which is 14.50. You divide it by 1.132, and the price comes to 12.809, or you can roughly call it 12.81 as the price for the next year, which this stock is going to have. So that's how you can calculate the prices. 1 year single year holding dividend discount model is a simple one. Yes, 12.81. I got surprised with 11.88. Here they have calculated separately. We can calculate it separately. We can calculate it together. There isn't any difference. The next one, as you see, is the multi-year holding dividend. What changes in case of multi-year holding dividend? Let me just get back to the pad. Let's note down our let's note down our formula for this. Again, very simple. The only thing that changes here is value at time 0 is equal to dividend at year 1 divided by 1 plus cost of equity, plus dividend at year 2 divided by 1 plus cost of equity whole square, right? Plus dividend at year 3 divided by 1 plus cost of equity whole cube. Let's assume it's a 3-year period. So you will add price over here. Price at year 3 divided by 1 plus cost of equity whole cube. So the simple way, the most simplistic formula for this, which we can do is V0 is equal to D1 divided by 1 plus RE plus D2 plus P2 divided by 1 plus RE whole square. And if it's a 3-year period, it becomes, instead of this, if it becomes 3-year, I mean, there can be n number of changes. So we can't write a formula for every time period. And the only thing that changes is it will become D1 by 1 plus RE, D2 by 1 plus R. Just give me a second. Yeah. For 2-year, it becomes D2 by 1 plus RE whole square. And if it is a 3-year period, it will become D3 plus P3 by 1 plus RE whole cube. So that's how your multi-year dividend discount model is basically going to work. Let's try to directly look at a question from over here if there is a question. Yeah. So let's look at this question. Would you want to take a crack at this one? And like I said, now it's going to be very, very number heavy, number intensive. Better if we can do these questions, right in the class, so that you're kind of more or less done with it. Be very careful. The time period over here is going to be I think the only area wherein you can make a mistake. So be very careful about the number of years that is provided. We can also simplify this formula. So V0 is equal to summation di by 1 plus rei 1 plus re whole to the power I goes from 1 to n. Is it done?
Almost.
All right.
$40.49.
All right. Let's quickly see what's done over here. Yeah, 40.49 is the answer. So we can maybe just quickly say that we are comfortable with uh, dividend discount model, be it a single period, multi-period. It's going to be pretty easy for us going forward as long as we are, using this specific generalized formula. I know using sigma and I and n and everything sometimes creates a friction, but I think it's a better representation because it's universally acceptable. So this will become dt by 1 plus re to the power of t, and where t goes from 1 to n, depending on how many time frames or time periods you have. So just use this formula. This is applicable for both single as well as for multi year time frame. If it is just 1 year, then t will go from 1 to 1, so you'll have 1 1 everywhere. So I think it's a, and of course towards the end the final one will be plus pt by 1 plus re to the power of t. Yeah. Or you can do pn by 1 plus re to the power n. So this is only dividend. You'll also have to add the price at the end. So more or less, whatever floats the boat, we can go ahead with any of the generalizations. That's not really what impacts our valuations over here. One more thing which we have to be careful about is the RE that we are using over here. So RE, if you see over here, we have been using a very generic one, which is the required rate of return. So if you see, in the questions that we just did, the dividend was provided, which is something that you can estimate. The prices were also provided, which is something you can estimate. The problem is rate of return is something which has been provided to us so far. When you are an analyst, you'll have to calculate this required rate of return as well. The best model that usually is universally accepted is called, sorry, not CAMP, it's called CAPM as usual. All right. So it is CAPM. This is also known as capital asset pricing model. Just a second. Capital asset pricing model. There's a formula which is in finance, I think it is repeated 10,000 times, which is your CAPM and how you calculate RE. So the required rate of return is RF plus RM minus RF multiplied by beta. Please note down this formula. While it has not been explicitly explained here, we'll get a better hang of this thing later on. But this is how you calculate the required rate of return on equity. And let's try to declutter this and understand this once and for all, so that later on, if capital asset pricing comes, and it will come, we should be able to understand this fundamentally, right? So what it's basically telling you here is the required rate of return on any asset class for that matter, not just equities, is nothing but the risk-free rate. If I break it down, this is called the risk-free rate, and this is called the market risk premium. In this specific situation, we call it market risk premium, and this is a beta adjustment. Now let's forget what RF, RM minus, RF, beta, all of these are just uh, heavy, so as to say, terminologies to use. At any given point of time, the required rate of return that you need will always be a fundamental buildup. What do I say when what do I mean when I say fundamental buildup? So let's just say there is one rate of return which is naturally available in the market, which is risk-free rate. What is the risk-free rate? In general, we call it 10-year government bond. Why do I call it risk-free rate? Because if you look historically, all the asset classes, one class which hasn't defaulted, I mean, there are exceptions to this, but if I have to just ask you, where can you park your money and be 100% sure that the money will be paid? You will say, sir, it's government bond. Does it mean that governments have never defaulted? No, I can give you exceptions about Russia, Greece, and all of that. But let's not go into a tangent which will unnecessarily open a Pandora's box. That doesn't help either of us. But if I invest in, if you give me $1 million and ask me, ki, sir, you invested at a place where there is 0% default, I'll probably park it in US Treasury bonds, because that's like the safest accepted investment across the investment fraternity. Now the thing is, whenever you're deviating from the investments, like whenever I'm, instead of making that investment in government bond, if I'm investing in something else, the only reason or the major reason for that investment will be to get a greater return. So why isn't everyone investing in government bonds of US? Because you want a greater return than what the US government is offering. So if you want slightly greater return, you might go for corporate bonds. Why will corporate bonds, like even the biggest companies, like let's just say JP Morgan, their bonds will offer a higher rate? So let's just assume, let's just create a hierarchy. Let's see government bonds. If government bonds give you 9% return, JP Morgan will have to give 10%. These are just again random numbers. The next step will be something like, let's just say, equity, or even before equity, you will have other corporate bonds. Corporate bonds of, let's just say, my company, Mr. X company, which nobody knows, you'll probably require a 14% return here. Next is, if you're going into equities, if you're going for JPM equities, you might require a 12% return. If you're going for a Mr. X equity, a company owned by Mr. X, in that case, you might need a 20% return. Similarly, if you're investing in crypto, you'll probably need a 25% return, maybe 45% return per annum. So the fact over here, the fact of the matter is, the more riskier the assets get, the more is the required rate of return on that asset. Why is the required rate of return increasing? In order to offset for that risk. Because if I say that equity gives 5% return and US government bond is giving you 10% return, why at all would someone invest in equity? You have all the incentive to only invest in US government bonds. So the fact here is, whenever you're investing in some other asset class other than, let's just say, government bonds or any asset class for that matter, it's a gradual build up, and you need to include more premiums on risk in order to offset the more premiums in order to offset the risk that you're undertaking. So in case of equity, the only reason to invest in equity will be, if I ask you that instead of investing in US bonds, actually invest in equity, you will say, sir, why? I say you will get a greater return. What is a greater return? You should ideally get the risk free rate. That is like the benchmark. If I ask you that invest in equities with 5% when the government bond is giving 10, you're never going to invest. So this is like the baseline. Follow it up with the incremental return that you can anticipate from the market. So what that return is, RM minus RF. What it basically tells me is, I'll tell you, see, US equities have given 15% return last 10 years. US bonds are offering 10% return. So the delta that you can estimate to make when you're investing in equities instead of bond is 5%. So that is what this RM minus RF does. So the bare minimum that you will need is RF. On top of that, you will need RM minus RF, which is the market rate of return offered by equities. In case of equities, this is market rate of return. In case of crypto, it can be crypto rate of return. So it depends which market I'm talking about. Here I'm not talking about crypto or anything else. I'm only talking about equities. So when you're investing in equities, you will say, sir, I'll need the risk-free rate. Plus give me the return over and above the risk-free rate, which is 5%. So what it comes to is 10% plus 15% minus 10%, which is equal to 15%. Now, if you see, this is exactly the same return, which in my example, US equities have given over the last 15 years. But be careful. I'm not asking you to invest in US equities. I'm asking you to invest in a specific US equity, which can be Tesla, which can be JP Morgan, which can be Morgan Stanley, which can be Bank of America, which can be SpaceX for that matter. I mean, although it's unlisted, but there can be any stock. So now I need to compensate for the fact that I'm asking you to invest in one of the stocks, not US equities. So RM minus RF tells you how much US equities give over the risk-free rate of return. And the final factor which I include is beta. What does beta tell me? Beta is basically a measure which tells me if US markets move by 1%, then this stock, which is the stock I'm asking you to invest in, let's say Tesla, moves by 1.25%. So this basically factors in all the externalities that you would need in order to build up the required rate of return when you're investing in Tesla. So let's go back and do the fundamental calculation. Let's just assume the risk-free rate is 10%, which means government bonds is giving 10%. I ask you that invest in uh, Tesla shares. So you will say, sir, if I'm investing in Tesla shares, I need more return. I'll be like, yes, you need more return. That of course makes sense. So the required rate of return when you're investing in Tesla will be, you will say, sir, ye jo whatever risk-free rate is, I definitely need that. US markets give 15% return and equities give 10. So you will also have to give me RM minus RF, which is 10% plus 15% minus 10%. So you'll be like, so this incremental 5% I'll need. But like I said, in case of Tesla has a beta of 1.25, which means when US markets move up by 1%, Tesla moves up by 1.25. If US markets go down by 1%, Tesla goes down by 1.25. So you adjust for this factor of 1.25, and at the end you have a overall buildup, which is basically 5 into 1.25, which is 6.25 plus 10. So the overall required rate of return for investing in Tesla will be 16.25%. Do you have any questions on what why RE is equal to RF plus RM minus RF multiplied by beta? Over a period of time, you'll memorize this only, that RE is equal to RF plus RM minus RF into beta. But I don't want you to memorize. I want you to fundamentally understand that you need risk-free rate plus you need, so this is RF, this is MRP, market risk premium, and this is beta. So please note this down, and should you have any questions, please feel free to clarify that. So that basically covers up our understanding of the required rate of return as well. Now let's do another model. The next model is free cash flow for equity. So the fundamental problem with dividend is that dividend is a part of the profit which is distributed. So if a company earns $120 and distributes 16.67%, it will distribute 20 and it will retain this 100. The fundamental problem with dividends is it only takes this distributed profit into account. However, this entire 120 belongs to the shareholders. So why should I only take a part of my income when the entire income basically belongs to me as a shareholder? So in an ideal world, I should not just look at the dividends, but I should look at whatever free cash flow is available for me as an equity shareholder. That is what the fundamental idea behind FCFE is. So FCFE has a very long, elongated formula, so as to say, but it's very easy to fundamentally understand. So free cash flow for equity is basically how much cash is available to the equity shareholders. It's not profit, but the cash which is available. So how can I get to that cash? The cash will be, you start by net profits, right? And then you adjust for changes in working capital. So you start with the net profit, you changes in working capital has to be adjusted. If working capital increases, you have to reduce. If working capital decreases, you have to increase. So plus minus changes in working capital, I'll just note that down. Then you will have to subtract the fixed investments. Fixed capital investments that you're making. You'll have to add back the depreciation which has been incurred. Plus, you have to take new debt minus debt repayment. Now, this is a super long formula, so as to say, but this can also be fundamentally understood. Ensure you're noting it out. Let me make it a little more simple also. Note this one down, however, this is more important. So FCFE is net profit plus minus delta in working capital minus fixed capital investment plus depreciation plus net debt. Let's do it plus minus as well. And note, if working capital goes up, it is reduced. If working capital goes down, it is added. So that should help understand when do we use plus and minus. So fixed cash flow for equity is nothing but net profits plus minus changes in working capital minus fixed investment plus depreciation plus net debt that you have taken on the book, which means add debt and reduce the debt repayments that you have done. Now let's try to understand fundamentally what is happening in this situation, right? I am trying to understand how much cash flow the word cash here is very important, is available for the equity shareholders, right? This is the fundamental question I'm trying to solve for. Now, what we essentially do in this situation is I have to look at the cash. So the fundamental starting point is net profit here. How do you get to your net profit? Let's just say, yeah, how much cash flow is available for the shareholders. So let's just see. Let's assume you have sales of 1000 less cogs of 100. 100 is a little less. Let's make it 400. Your gross margins or gross profit is 600. You will have operational expenses, which will give you operating profits. From your operating profits, you will reduce depreciation, you will reduce interest, you'll be left with earnings before tax, you'll pay your taxes, and you'll have final profit after tax. So let's assume depreciation is 50, interest is 50, 300. Let's assume taxes are 150, and you're left with a PAT of 150 in this situation. Now you have to be very careful about the thing which is in hand. Ki I'm not worried about the profits over here. I am actually worried about how much cash is available to equity. Cash is not the same as profits. So you start by assuming that this PAT is what is available as cash, right? Then the next immediate change which you do is plus minus working capital. Now, what does working capital tell me? So if you remember the discussion that we had earlier, let's assume you have done this sales, right? Now let's assume debtors at the start was 200 and debtors at the end is 300. What does it tell me that debtors have gone up from 200 to 300? It basically tells me that 100 is not realized in cash. This 100 increase in debtors is basically not a realization in terms of cash. The debtors have gone up. I've made the sales, but have I received cash in my bank account? No, I have not. That is why it becomes important to adjust for working capital, and working capital includes debtors, creditors, inventory, and there can be others, but let's just assume these three are the major components. So whenever money is stuck with debtors, it basically means that you have made the sale, but you have not realized your cash against the sale that you have made. So that's why adjusting for working capital becomes important, because while you have booked the profit, but this 100 increase in debtors is not realized by you by way of cash. So that's why this adjustment for working capital. Next thing is, if you look at it, interest is an outflow. I paid it in cash, but depreciation is not paid in cash. This is not a cash expenditure. That's why I add back the depreciation. While I'm adding back depreciation, one thing is capex, which is capital expenditure I'm doing. If you look at the entire income statement, I have not reduced capital expenditures anywhere, because capex or capital expenditure is not a part of P&L. It goes to the balance sheet directly. So over here, I also need to reduce the committed capital expenditures, because this also goes out of cash. So my entire premise, if you think, I'm just thinking from the perspective of cash. I start by saying that my net profit is equal to my cash. Then I make the adjustment for working capital, because there may be some amount which is stuck in working capital. There may be certain amount which is released from working capital. So that is an important adjustment to make. Depreciation is something which is a non-cash expenditure. Capex is something which reduces the cash, but it does not reduce my profitability. So this is again an important assumption or an important instrument to include within your cash flow analysis, right? So capex is a cash outflow. Depreciation is not a cash outflow. Again, with debt, what happens is, when you take new debt, money comes in. That's why I've added it. When you repay debt, money goes out. That's why I've reduced it. So that's how you get to your free cash flow for equity, right? So this ultimate uh, cash flow analysis, it will give me the free cash flow for equity. Now this analysis is not done for 1 year, it will be done for multiple years, and the value at time 0 is going to be nothing but exactly the same which we had done earlier. It will be free cash flow for equity at time t divided by 1 plus the required rate of return, which we just discussed, to the power of t, and summation t goes from 1 to n. So this is exactly the same as the dividend discount that I was doing. But instead of using dividend discount model, I'm using a free cash flow on top. So instead, the only difference between this and dividend discount is, in case of dividend discount, what I do is V0 is equal to summation DI by 1 plus I, sorry, by 1 plus by 1 plus RE to the power of I. I goes from 1 to n. And in case of dividends, I also add up the last price. So price at time t divided by 1 plus RE to the power of t or n, whatever it is. So here I'm discounting all the dividends. Here I'm discounting all the cash flows. That's the only fundamental difference between free cash flow for equity and dividend discount model. So be very careful about these two things. Note down this FCFE formula. So in case of FCFE, value 0 is equal to sigma t goes from 1 to n, free cash flow for equity at time t divided by 1 plus required rate of return to the power of t. So this is another formula that you have to remember in order to ensure that we don't end up making any mistakes in this situation. Just understanding this is more than sufficient. I don't anticipate that they will give you a question to fundamentally calculate free cash flow for equity. Even if they do, it's not that difficult as long as we remember, or we don't even have to remember, you just have to understand the formula. Start with net profit, working capital. If there is an adjustment, I have not gotten that cash, so I'll adjust for that. Capex is an outflow of cash, depreciation is an inflow of cash, and finally you adjust for debt. If debt is coming in, it's a cash inflow. If debt is going out, it's a cash outflow. So once you've adjusted for this, you will get to your free cash flow for equity, and this free cash flow for equity gets divided instead of your dividends, which were being divided earlier. So that's the only thing that you need to remember. So we have done free cash flow for equity. We have also done cost of equity is equal to RF plus I don't know, for some reason it isn't working. Now it's all of a sudden. Cost of equity is what this is. Anyways, I think we have already done this. So cost of equity is RF plus RM minus RF into beta. Just give me a second. I'm rejoining. Yeah. So you have RF plus RM minus RF multiplied by beta. Just ensure that you keep these two formulas aligned. Follow it up with, let's just say, the last one, and maybe we'll do a question on this as well. The final one is called a Gordan growth model. So something called Gordan growth model. What happens in case of Gordan growth model basically is that instead of having a finite time period, what if, because fundamentally equities have infinite time, equities have infinite time, right? And this is again a Gordon growth model, basically depends on your dividends only. So earlier I was giving you that, okay, if it is a 1 period, you will do D1 by 1 plus RE. If it's a 2 period, you will do, sorry, D1 plus P1. If it's a 2 period, you will do D1 by 1 plus RE plus D2 plus P2 by 1 plus RE whole square. If it's a 3 period, you will just add a 3 to it, and I mean, it keeps going forward. The problem, however, fundamentally with this is everywhere I am assuming the price at a given point of time. Who gives you this price? Nobody, right? It's just a crazy out of the blue assumption that you have made. So there are two fundamental problems with it. Number one is you're assuming a finite time period, 1 year or 2 year or 3 year, as the case may be. I can't technically build a 500-year fundamental model with this because that will become a little too much. But in reality, equities are a perpetual instruments, right? So in order to solve for that, the actual value, if I were to ask you what is the actual value, the value will be just by the normal model which I was using. The actual value will be D1 by 1 plus RE plus D2 by 1 plus RE whole square. And it keeps on going forward, plus D5000 by 1 plus RE5000, RE to the power of 5000, right? And I can have I mean, I can have more than 5000 as well. So fundamentally, if I just break this down further, value 0 is nothing but, so now I'm just decluttering it even more. Today's dividend into 1 plus growth, which is the next year's dividend, divided by 1 plus RE. Dividend 2 years from now will be today's dividend into 1 plus the growth rate whole squared divided by 1 plus the required rate of return to the power of 2. Time 3 again, I mean, it's just the same. It will become D0 into 1 plus growth whole cube divided by 1 plus required rate of return whole cube. Similar to that, towards the end, it will be dividend 0 into 1 plus growth to the power of n divided by 1 plus required rate of return whole to the power of n. So this is how your formula is actually going to be structured. Now, if I try to divide this formula and make it a little simpler, what it is actually going to look like is, and there's a long, sorry, yeah, there's a long proof to that, but proof is not really required over here. We just need to remember how to do this. If I just subdivide it, assuming that it's an infinite arithmetic progression, you can just do v0, and then if you multiply, you'll basically get to that number. But let's forget that for the timing. This infinite arithmetic progression can get simplified to just one thing, which is d0 into 1 plus the growth rate divided by re minus g. So this is how your formula basically comes to. This is called infinite Gordan growth model. D0 into 1 plus g can be written in a separate way. Instead of writing D0 into 1 plus g, you can also write it D1. So there are two formulas to it. You can, because D1 is equal to D0 into 1 plus g. Dividend at the end of year 1 is dividend at the end of year 0 multiplied by 1 plus the growth rate. So value today is next year's dividend divided by RE minus G, or D0 into 1 plus G divided by RE minus G. So please note this down, that if it's an infinite life Gordon growth model, the dividend is nothing but D1 by RE minus G. So that is all that you need to remember. D1 by RE minus G. Sometimes G is also known as growth of equity. So whether it's GE or whether it's G does not really make a dent. It does not really make an impact, right? So this is the formula that you need to remember. What if G is equal to 0? There is no growth, which means you get the same dividend every year. A dividend of $5 paid every year, and the growth is 0, and RE is equal to, let's just say, 10%. So now if I just put it over here, it will become D1 by RE minus G. D1 is going to be $5. RE is going to be 10%. Growth is 0%. So the price here will be 10 by 5 by 10%, which is 5 by 0.1, which is equal to 50. So that's how you can fundamentally calculate the prices of anything which has an infinite life. So the two formulas are D1 by RE minus G. If G is equal to 0, it is D1 by RE. So this is a special situation when G is equal to 0. But all you need to remember is V0 is equal to D1 by RE minus growth of equity, or growth of dividend, as the name may be called. So just note this down, and this will more or less cover up, I think, whatever we wanted to cover up today. We're kind of short of time. Wanted to cover a little more things, but not sure if we'll be able to do that. Let me check if we have any question on Gordon growth model. I think we do. We've done free cash flow for equity. Just remember this special formula. So we have debt and this, yeah. So we have covered this as well. This generalization is a simple formula that you should remember. What we need to solve, the last question. Let's just do this question, and I think that will more or less do for the day. The question over here is this example: calculate the value of stock that paid 1.5 dividend last year if the dividends are expected to grow at 8% forever and the required rate of return on equity is 12%. Fairly straightforward, fairly simple. You just need to put in the numbers in the formula and you'll get your answer. So take out a couple of minutes, try to solve this, and we are done for today.
Is it 40.50?
I'm also doing it very quickly. So D1 is 1.50 into 1.08. 1.5 into 1.08 comes to 1.62, which is the next year's dividend. RE is 12%, so it is 0.12. Growth is 8, 0.08. So I have to divide 1.62 by 0.04. The answer comes to 40.50, exactly what you just said. So yes, the price in this situation will be 40.50. So just ensure that you're noting down these formulas. Dividend growth model, CAPM, and others that we just discussed, especially the FCFE. Just keep a note of the formula. Like I've said, don't anticipate a very difficult question from over here, but always good to know how this formula is structured. Just try to go through this formula today so that tomorrow I'll come up with maybe a couple of questions, and that will give us more comfort in being able to solve a FCFE question as well. But the idea over here remains the same. You take the cash flows. It can be dividend, it can be free cash flow for equity, it can be infinite growth dividend model. So the price is nothing but next year's dividend divided by 1 plus RE, and the next year's dividend divided by 1 plus RE, and the next year's dividend divided by 1 plus RE. You keep on doing that. If it's a 1 year model, very simple. If it's an infinite model, it becomes D1 by RE minus G. That's it. So that's all you need to remember. If you just remember D1 by RE minus G, I think that solves more or less everything else that we need to remember, because or maybe 2 D1 by RE minus G and DI by 1 plus RE whole to the power T, sigma T goes from 1 to N. If you remember these two formulas, you don't have to remember anything else from this chapter. So that's it for today. I'll see you tomorrow, same time. Bye.